Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Hello and welcome to this episode of the Australian Finance Podcast. I'm your host, Kate Campbell, and today for our listener Q&A for July, I'm joined by my co-host, Owen Rask.
Thank you, Kate, for having me.
And I've got Drew Meredith, a financial advisor from Wattle Partners, who we hang out with here in the office.
A little too much sometimes.
Yeah.
Good to be back.
Good to have you back on the show. So we're opening up your questions, and you can send us questions anytime during the month by hitting that link in the show notes and the podcast description.
Yes, you can. And we should add that there's an extra disclaimer because we are answering questions. We have to be very mindful that when you send us your information, we do, in effect, we generalize everything that you send us. So we have to do this because we don't know what your circumstances are, your goals, your objectives. For example, you might want to go whitewater rafting in Alaska, and we don't know that. So we simply do not know your objectives or your goals in life. That's what you need a financial planner for, like say Drew here or someone who is licensed that you can verify through ASIC. Do not trust any advisor until you check that they do operate under an AFSL, Australian Financial Services Licence. You'll find more information about us in the Financial Services Guide that's available on our website, as well as the Wattle Partners Financial Services Guide if you want to go there.
Wonderful.
That's it.
Well, instead of a buy, hold, sell this month, because I didn't have any good ideas for that, I thought we could discuss what we do in a fictional scenario where we got $1,000 tax refund, because we've hit end of financial year. People are starting to think about doing their tax returns, and maybe people might be getting some money back.
Yes, last month we did say chocolate should go in the fridge.
Along with sauce.
And along with sauce. Although, no, who disagreed with that? Someone, okay.
I quit after that, I'm pretty sure.
Oh, yeah, welcome back. So what are we going to do with our refunds, Kate?
Yeah, so what are you going to do, Owen?
I'd put it towards my boat fund.
Not the farm fund?
Not the farm fund. No, I'm actually separating money out. I started a new business on the side, and I'm using that to generate money to buy a boat. I can explain why, but that's it, yeah.
Yeah.
Like a tinny?
No, I'm buying like a expensive boat.
So
and
your
I need to
boat's
save
your
for a long time.
new medium-term financial goal, is it? And the farm's the long-term one?
Yes. But I can't use house money for the boat, so I have to find another way to... So I started a business. So
Can we ask what that business does?
Yeah, sure. So it's a business coaching business. It's like, wow. It's two businesses. So I've been coaching some small businesses, micro-sized businesses under 10 employees to grow online, to shaping up their financials, to grow e-commerce brands, use marketing, grow podcasts, whatever. I do that on the side. So 9 to 5 is Rask, and then early morning before work I do business coaching. And I'll tell you why it started, because of the boat, because I wasn't allowed to use house money to buy the boat, but also have this view that boats are very low utility. What I mean by that is they cost a lot of money, but you only use them for a very small amount of time. So if you think about it, the utility is incredibly low. Utility is just a fancy finance word, but yeah, it's incredibly low. So I took my part of our budget every month, we get our own little play money, use that to start a company in ASIC, spun that up, got a website started for $50 and have started to roll.
For some reason, this just sounds incredibly dodgy. I don't know why.
It's a mustache. I think it's a mustache.
If you're watching on YouTube, you can see Owen's new facial attire.
Yeah, just keeping it real.
So have you got any money in the boat fund yet?
$1,000.
Couple grand.
Okay.
Yeah. So it's happening.
It's rolling along.
Yeah. No, it is happening. But the problem is I went for my boat license the other day and then they saw that I wore glasses, and now I have to wear glasses everywhere I go, apparently, according to Vic Roads. So they cut up my other license.
Oh, gosh.
I thought they didn't have lenses.
No, they're not just for show. I've got these straps too, so they don't fall off my head when I'm on the boat. You see, I'm already preparing.
Oh, gosh. All right. All right. Well, you can let us know how you go with that boat fund. But what about you, Drew? What would you do with a $1,000 tax refund?
Well, I usually just tell people to do the right thing, which is go and pay off debt. But in this case, I assume someone else would say that, not you, unfortunately. I think it's better time than ever to put some to work in the market. Go buy an ETF and start compounding. We know that the best time to start was yesterday or today.
Yep.
More so today. And if you've listened to the other podcast, I'm not a pretty big fan of FANG at the moment. So buy a diversified ETF.
Well, so like a FANG ETF.
Or IVV. So S&P 500, something highly diversified and compounding world's best businesses.
Yeah.
Put it to work.
Yeah,
Assuming you don't have, always a disclaimer, credit card debt, all those kind of expensive, wasteful forms of debt.
Yeah, we're assuming that you have got your house together.
Exactly.
Yeah, and read the PDS. Consider if it's right for you. Global X is a sponsor of the Australian Finance Podcast. Just insert that, but that's a good idea. Like that. Great.
I assumed Kate would say pay down debt.
Kate, come on. What do you got for us? $1,000. What are you going to do with it?
Well, I'm already investing and I'm already saving, and I think I'd buy a few things. So I just paid
spending?
Very expensive Taylor Swift tickets. My sister sent me an expensive bill yesterday.
She got them.
She did.
There are about 7 computers in here on the same IP address, all trying to get Taylor Swift tickets at the same time.
Yes, well, at her work, she set it up on multiple people's computers. So I said yes because it would be an experience with my sibling and it would create memories. That's important.
That's at the MCG, right?
Yes.
And last time she was here, she was at one of the other stadiums, Marvel, maybe?
Probably Marvel.
And so that would mean that she's basically doubled the size. Is it one night or 2 nights?
No, she's just announced 2 new shows.
Wow.
There's at least 3 in Melbourne now, and there's more in Sydney.
So that's going to be bigger than Ed.
Yeah,
Ed
it's going to have more
Sheeran.
people.
Her first name
But she's not going to as many
Big
states.
fan of Ed.
But remember when Ed Sheeran... So for people... Sorry
I
for
was
people that
there.
aren't here in Melbourne. Yeah, but you were
It
there,
was
so you're going to
amazing.
go to the 2 big ones.
He did Amy Park. I remember going to Amy Park.
I went to the Amy Park one.
Yeah.
But he was here for
Years
2
ago.
nights in a row, over 100,000 people.
Yeah.
I was trying to get out of a car park. Can you imagine? Anyway, that's great.
Yeah,
Spend
it on a few things. I think I've got my finances on track this year. Everything's been set up, automated. It's happening. I'm happy with the progress I'm making. So yeah, I think I'd spend it on a few things.
The other one's
Good on you.
get out of Melbourne. It's freezing and raining at the moment. Where's my third
Shout
one?
out to everyone else.
Maybe
That's
go on
actually
a
really
weekend
good.
away somewhere.
That's actually really good. That all 3 of us, you know what all 3 of us didn't do? We didn't say we're going to save it.
Yeah.
We said we're going to do something with it.
Yeah,
And a lot of people, when they listen to finance podcasts, they'll be like, save it. Or people around you will say, save it. We're saying, no, actually spend it, use it wisely, invest it.
Yeah, my just big thing with your tax refund, if you do get money back at tax time, is just write a little note down about what you do with that money, whether it's paying off debt, spending, saving, investing, because then over the years you can look back and go, okay, this is what I did with that money, because chances are at the start of your career you'll probably get something back. And it's kind of cool to know where that money went over the years, because I look back at the tax returns I got when I was 18 and 19, and I was getting a bit of money back then, and I have no idea what I did with it. Just went into general revenue. So I think if you write down and just to be intentional with the money is all we're saying, really.
Yeah.
I think maybe we're the ones creating inflation if we're telling everyone to keep spending rather than saving. So
Spend. Yep, that's good. I like it. So we do obviously, all of us would say on the proviso that you've got your financial admin and your financial house in order. If you do have credit cards and those types of things, they may be more prudent ways to distribute your money.
Yeah.
Or pay back debts and that sort of stuff. Cool. Like it.
Awesome. Well, when I had a look through our podcast inbox this month, we do read everything that comes through, is something I did want to point out. But we had a comment from last month's Q&A when we talked about investment bonds, and this came through from Lee the Noob. That was their chosen username.
Yeah, I
I'm
like
just repeating it.
Okay.
But I just thought I'd mention this
Actually,
comment.
Kate just made that up. Shame.
And see what thoughts you guys had. So Lee said that I'd just like to draw attention to a statement you made about investment bonds, insurance bonds in brackets, on our recent Q&A podcast. You said that investment bonds are tax-free after 10 years. This is not actually correct, but rather they're tax-paid investments, a key distinction. So the effect here is that investment bonds are better for income-producing investments, but a poor option for growth-type investments. Also, another key benefit of insurance bonds is the asset protection and estate planning benefits, which are completely separate to the tax situation. So, Drew, I'm handing it over to you. What are your thoughts on this?
Yeah, I think it was, I can't remember which one of us said it. I'll say it was me.
I'll say it was me. It's probably me.
But it's completely true. So it's a tax-paid entity, like any kind of company sort of structure. It gets the benefit of the company tax rate, and the explanation there is perfect. It's become it's becoming of a lot more interest lately with the acceleration in changes to superannuation laws, in particular, the $3 million cap, not a cap. That is coming through. And basically, it's just another reasonably tax-effective entity for people on higher incomes or people wanting to, start savings accounts for children without the tax implications, which we have that question all the time. But we caught up with Grant Hackett from Generation Life, which would be one of the biggest, I think one of the top 3 issuers of investment bonds. And there was quite a unique fact or kind of learning even for us that came out of that, whereas they talk about the tax rate being about 25 to 30%.
That's in the question here, the bit that we didn't read out. Yep.
Yeah, exactly.
Yep.
But the actual tax rate within some of these bonds can be as low as 12 or 13% because of the way they're able to manage and control the trading that occurs on the investments within them. So you may not see that in the tax you're paying, but in the after-tax return being produced by that bond, it can be significantly, and it generally is significantly higher than the after-tax return if it was held by a managed fund, which is kind of a less appreciated benefit of the structure.
Yeah. Yeah, it's also worth noting that when we may have said tax-free, what we meant is it's tax-free to bring it out.
Yep.
Not necessarily that it always pays tax in insurance bond. So
The government doesn't let you get off
you don't
paying
just get
tax
it,
that
no
easy.
tax for the rest of your life. So we probably simplified the language rather than we didn't mean to say that you aren't paying tax. It's just that it simplifies it because no one knows what tax paid means.
And that assumes you don't take it out early. There's all kinds of restrictions around that tax paid status as well.
Yeah, if you take it out before 7, 8, 9 years, 10 years, you're going to be there will be basically a price to pay.
Yep.
Yep.
And you can have different things inside that investment bond.
Absolutely. That's why people use them. So just for those that didn't
like a
take part
wrapper.
last month, you basically just, your money is committed into this thing, which is its own entity, basically. It's called a bond. They existed before superannuation. And they create their own tax structure. So people on high incomes typically use them because they can hold some investments inside of them and they kind of pay their own tax and it's all administered. There are fees and things to consider, which is why we say get advice on these things. But they're going to become, as Drew said, more popular because of the changes that are always happening to superannuation, which is a question on that too, which will be a good one.
I mean, if people are really interested in this topic, send us a message and let us know and we could talk to someone from one of these companies and actually do
That'd be super keen.
a deep dive into investment bonds because we haven't done that as a standalone episode.
Yeah.
And we've got, I think every week we see a question on it.
Yeah.
Whether it's on
for
AIP
them.
or
Yeah.
AFP for sure.
Okay.
Yeah.
Cool. Well, definitely something I can look into. All right. The next question from #AreWeThereYet is about dollar cost averaging versus lump sum investing. So here's a question. Hi guys, big fan and listen to the podcast via YouTube and Listener. So the question is about dollar cost averaging and brokerage fees. While it might be better to invest gradually, every time I do that, I'm going to pay a brokerage fee because there's more transactions. So how should I approach this?
Yeah, there's actually some calculators online. So I think there was one from Perla, sponsor of the show, but there's also one online somewhere. It's made by an engineer, I guess, somewhere. And in effect, the only way to wrap maths around this is to have an assumed rate of return. So you might say it's like 6 or 8% a year or something like that. And then to input how much you save, and then also to input what your brokerage cost is. And basically, if you pay about $10 a month, $10 per trade, so to buy an ETF, it effectively works out that you want to invest $1,500 or more. So you want to save up to that amount. But if you use a brokerage that has less or lower fees, like one of those ones that don't have a HIN, they might be like $3 or $4 or $5, then obviously the minimum amount that you should invest reduces. But at the end of the day, the only reason we say this is because typically over the long run, the stock market goes up. And the longer you take to invest some money, the less time it has to compound, to Drew's point earlier on. But if you only invest $500 and it costs you $20 to invest, not that it would, but if it did, that's a substantial portion.
Fees are incredibly important.
Yeah.
When you're looking at long-term returns. Like the lower you can get your fees, whether that's brokerage or ongoing fees, the better.
Yeah.
I was searching for hours last night trying to find a white paper that said the most efficient regularity of dollar cost averaging? Couldn't find one.
Yeah.
Did you, either of you, have you had any experience? Is it monthly, quarterly, 6 monthly?
Well, there is that calculator that we've shared with our community before, but I think just building that habit is almost more important at the beginning. You might be paying a little bit more in brokerage, but the brokerage is really coming down in a lot of places.
Yeah. And so basically it comes back to your savings habits, I think. Like, I don't think, maybe unless I had like what we call a research stake, which is where you put like the minimum in like $500, which is like your ticket to the dance.
Yeah.
So then it makes you research
Less
a
cost
company or a stock or a ETF. It's typically in the thousands of dollars. But there's micro investing as well for people that have smaller balances, like Raise, Perla. I can't think of any others off the top of my head. Sharesies might offer something like where it's only fractional type investing. So, I mean, the message should be just get invested.
Yeah.
I think the key with dollar cost averaging isn't necessarily the regularity, but the removing of emotion from automating the savings part, but also automating your reaction when the market falls. So it's when the market falls, make sure you're not stopping your dollar cost averaging. That's the whole benefit of it, is buying then, but also buying when it's increasing.
And if you haven't automated that, it's quite hard to keep investing on a regular basis if you are seeing your portfolio fall in value, which is often the best time to keep investing.
That was every white paper I read last night was...
You had quite a time last night.
You just get into rabbit holes sometimes when you...
Kids to bed, white papers on.
Exactly. Had a cup of coffee and go into it. Maybe the coffee at 10 o'clock coffee didn't help. But there's heaps of white papers on it, and a lot of the time it is very much focused on the emotional and the psychological part of investing rather than the sheer financial benefit.
Yeah. And that's what we say, just keep invested.
Yeah.
Automate
Small
it if
bits,
you can.
lots of times.
Yep.
And don't stop.
Don't stop.
Don't stop. There's got to be a song about that. So the next question comes from Fallen Hair. Now, this is a good question because there's a few elements wrapped up into one, I thought, Kate.
Yeah.
It says, hey guys, thank you for the educating and entertaining podcast. Appreciate the work you put in. I have a burning question which is driving me crazy, making me lose my hair. My son is 17, turning 18 this August. Happy birthday to your son. Number one, I am intending to gift him either VAS, which is the Vanguard Australian Shares, or VAP, which is the Vanguard Property Securities ETFs, in the value of approx 10K. Number two, I've been researching the best way to do it and now have two options. A, buy them via a regular stock trading platform which charges a fee for every purchase, i.e. brokerage. Or B, buy directly through Vanguard. I have tried comprehending the charges involved by Vanguard, but I'm having a hard time understanding their fees. My intention is to make him chip in fortnightly/weekly based on his pay date and approx $200 a fortnight, as time is his best friend now for compounding. Finally, or do you think just forgetting all of this and chipping in the 10K to his super and then making him salary sacrifice another 12.5% of his income, making the total contribution 25% of his salary would be a better idea? Thank you again for striving to educate us. Thank you, Fallen Hair. Who wants to go first?
I feel like forcing a child to salary sacrifice might be difficult.
That was one of my notes.
Sorry, I stole that. An 18-year-old to salary sacrifice more of their income, I think that's going to be a bit of a struggle. But the idea of getting started compounding is incredibly powerful, and starting that lesson is key.
Yeah, I think I would focus on the education piece probably before giving the gift, do you think? Because otherwise, if I was given $10,000 when I was 18, it'd be burning a hole in my pocket and I'd probably figure out how to sell it. Do you think?
Yeah, probably.
Maybe focusing on the education piece first and talking through what investments are, maybe sharing some resources, talking through what the Australian share market is. So when you do gift an ETF, they actually know what that is and why that's valuable to keep it invested and hold on to it over a long period of time.
And be clear on the purpose was one of the notes I had. Are you giving it to them to buy a car, to buy a house, just to compound forever?
Yeah.
Like, they will try and sell it at some point, so try to be clear at the time.
Yeah. I mean, I think a lot of gifts often come with strings attached, so maybe explaining, what it is for.
I think the intention's right, The intention is I want to help my son out when he turns 18. And then the intention after that is to encourage them to regularly invest. I would... One of the things, if you read one of the Barefoot books, like for kids or any of the kind of literature around this, it's that they have to earn it. And so if they earn what is given to them, they have an appreciation for what money is. Because if you just hand it to them, it's easy come, easy go, right? So I would say if you're confused by the Vanguard fees, get them to interpret it for you. Get them to sit down with you and go through it and figure it out together. That's a very subtle way for them to earn it and be interested in it.
Yeah. And maybe they call up the Vanguard personal investor team and actually you could talk on the phone together and get an understanding. They should be able to talk you through the fees and costs, how the platform works. They'll be able to give you a factual overview of the different products and how management fees are taken out. And that could be a really good learning experience to do together. Yeah,
well, that's something that we spoke about at the ASA event. And it's a good point to bring up, Kate, which is a lot of people when they think, and I know you come across this a lot, Drew, is a lot of people when they think about the next generation, i.e. their kids or grandkids, they immediately jump to, well, do I need like a trust? How do I send my super if I die? Do I need to speak to a lawyer, etc.? No, actually, the most important thing is actually to educate them, like the next generation.
Share knowledge.
Share the knowledge so they don't make the same mistakes that you might have made, or they know how to protect what you're giving them.
Yeah.
Exactly.
So that's probably just as powerful as any, if not more.
And to do that, you also need to make sure it's relevant to them. So how do you have an investment if you're going to use investments that they can connect with? You know, the old days of giving BHP and Telstra shares to your children, I just say that's kind of gone because your kids don't really want, even though I recommended Telstra here last year, 12-month high. But it's hard for people to connect with Telstra, young people. Hard for young people to connect with BHP. So how do you find investments that they're more likely to connect with, I think is incredibly important. And there's so many options now to do that.
And helping them figure out what their goals might be. Maybe it's going to Europe during uni or buying a car, and because then that gives them a reason. Because if they're going to put money aside when they get paid for investing, they've probably got some other savings goals and things they want to do with that money as well. So even stepping back and going, okay, maybe you've got a part-time job, looking at budgeting and where the money's going and helping them figure out, maybe they're moving out of home and figuring out how to pay the bills and prioritize all of their spending, and then putting some money aside for short-term goals. And maybe there is a little bit left over and we can go, okay, this could be put aside for long-term investing and building wealth over the next 50 years.
Yeah. And it just comes back to that. I think this person's got all the right intentions with their children. The execution may be something that needs a bit of work here. And in particular, I think that the idea of salary sacrificing into super at the age of 18, for me, is actually, I think that's riskier than anything else. Because I think if you are encouraging them to say, hey, put all this money into super and you'll get it when you're 65, 75, 80, who knows, by the time they're, we really don't know. Yeah. We just mentioned all the risks that are happening to super right now.
Anything could happen in the next 42 years.
Yeah, that's it. So,
and young people often want to have more touch and feel over their money. They want control. They want to see how it's working towards their goals, and they're getting on their feet, maybe moving out of home for the first time. So I think maybe keeping things a little bit more liquid in that respect.
Yeah, that's a good point. Yeah.
But it's awesome to work through this together, and it's not going to happen overnight. It might be a few years that you work on this together and build those skills. I mean, I still ask my parents questions about my finances. A few years ago, we called the health insurance provider together, and they helped ask some of the questions on the phone because they thought of things that I wouldn't have thought of. I wouldn't have thought of all the things that I might want cover for, or the questions I should ask the health insurance provider, or things like what are the different waiting periods, and having them to go through that phone call was a really helpful tool. But I came to them and kind of asked for that as well.
We've talked about this on the show before, but one thing that I do with my sister, which would be perfect for this person because it weaves through our points here, is find 5 or 6 brands that your son is interested in. So if they're into sports, maybe it's Nike or whatever. Apple. Maybe if they're into video games, it's like Roblox, or maybe it's like Activision, Nvidia, whatever. Whatever they're interested in, find 5 companies, or maybe not so much ETFs because they're a bit distant, but find 5 companies that they're interested in, take it and get them to say, hey, I'm looking at making this investment. Don't even tell them it's their money. Which of these 5 companies, I've been presented with these 5 companies, which of them do you think would be the best?
And you can tell by just looking around the house. You'll see what they like.
Yeah, and then get them, that's the way to get them into the conversation. You'd be like, oh, but this share price is down, and just play dumb and let them talk to you. And it's just a way for them to learn what you're actually doing.
Yeah.
It's not just
So
numbers on a screen.
connect at their level, find ways you can work on the finance and investing piece together and help them achieve the goals that they want to work towards.
Yeah.
And yeah, it will take more than overnight, but I think this is a fantastic journey to go on together, and that money's sitting there when you're ready and when you think they're ready to receive it.
Yeah, another way is if they're a competitive person, you could say, if you pick one of these companies, we'll put $1,000 in it, and if your company beats my company in a year, even though that's pretty short, or 6 months or whatever, then you can have the money. And it's just to try to get them to buy into what it is that you're trying to feed them.
Yeah.
But if you say you're doing this, it's probably not going to.
Here's your Telstra shares.
Yeah. Unless. Anyway.
Yeah. Getting people on board and working towards the goals that they want to work towards is a good approach.
Absolutely.
But awesome thinking about your own son's financial future. I think that's fantastic.
Mm-hmm. Absolutely.
Okay, the next question is from Debt Free Medic about what happens in life after HECS, our higher education loan.
Yes.
I am still growing mine. Thank you very much. Okay, question is, I've paid off my HECS debt to avoid the hefty, I was going to say hexy, the hefty indexation, and now I'm officially debt-free. Yay. Since I have no debt, what is a potential next step to consider to reward myself in the future? Should I think about investing, buying property, saving more?
That's a good question.
I've got the perfect answer.
Go for it. Oh. Go for it.
It depends, like it does for anyone. I know that I'm married to a doctor, so I know a lot of doctors. And historically, as soon as your HECS debt's paid off, doctors are kind of suggested to go and borrow money, invest in property. And for the last 25 years, it worked incredibly well. But it does very much depend on what your objectives are and what you're seeking to do over the next 5, 10, 15 years. So do you want to buy a house? Do you have a house would be the first question. Do you want to buy a house? Are you likely to move regularly? Do you want to travel? What does your future look like? Medicine is incredibly expensive to study anything in medicine. You're going to have exams that cost hundreds, thousands and thousands of dollars in the coming years too. So at first is define your objectives and what you intend to do. At the very least, you just want to be putting it into some government guaranteed cash and get that 4 or 5% interest and then make decisions from there. But you're correct. It's invest, whether that's property or shares. Assume you don't have any other debts. There's no other debt to pay off, and then maybe it's saving for the boat or saving for the farm,
or a forest.
Or a forest, yeah.
Yeah.
But I think even just stepping back, taking a moment to go, hey, I've paid off this big thing. You've probably been working to pay off a medical HECS debt. You've probably been working on this goal for a while. So it's a great moment to reflect and think about everything you've learnt during that process. And maybe you go out for dinner with your friends and family just to celebrate, because it's good to recognize those milestones. And I think paying off debt, whatever kind of debt, is a really good milestone to acknowledge.
Yeah.
Definitely.
Yeah. It's good on you, really. I think people listening to this might be saying, well, should I pay off my HECS? Because we've been hearing that a lot in the media lately about, there's been a lot of outrage on some channels where people are like, indexation, it's going up so fast. Went up 6%, 7%, whatever. I've got a lot of HECS too, and I'm probably about to rack some more up. So, and I don't care, to be honest, because I still think it's the cheapest form of loan that you'll get anywhere.
Over the long term.
And how wonderful it is that we're in a country that allows us to do this. So I think for anyone, doesn't really matter who you are. Maybe if you're a in this case, they say medic, it could mean medicine, it could mean paramedic, it could mean a few things. But if you're going to earn more, you should be able to do what a lot of people suggest, which be your minimum 10% super, which your employer will pay. If you're self-employed, do it yourself. Just be paid in. But then you should invest some on top of that. Maybe 20% of your income is a rule of thumb. And then go and live your life according to your values, really. Yeah. I'd say that's probably the most simple thing. It's like
probably a good time to just sit back and go, well, what do I want to work towards? What are my goals? Do I want to go over to Europe for a year or two and work overseas? Is property something I want? Is there another short-term goal I want to work towards? Or is there a long-term goal I want to work towards? So just, I guess now that you've got a bit more cash flow, you've got money to direct towards one or two goals.
You know, one of the main reasons people paid off their help debt was because they wanted more lending capacity. Because that's probably the biggest impact when you have a help debt, is that your lending capacity from a bank is reduced because of that reduction in your pay.
Yep.
So that seems to be why a lot of people have done it and brought it forward when they could just keep it on average at 3% per annum or thereabouts.
Yeah, that's it. Because the banks look at it now, and they look at your HECS, your credit cards, all that stuff. Buy now, pay later. So a lot of people do pay those off before they go for their loan. So my comment about not really caring about it, it's more so I don't really need to worry about that, but in certain circumstances you would. I would say one of the great things about this person's situation, we can't give personal advice, we have no idea who you are, but one of the great things about the situation is they've developed the habit of saving, which can be easily ported to investing. So if you're regularly paying off your HECS, we'll just take the money. If you want to keep that habit, and it's a great habit to have, then start investing. And you have already flexed that muscle so many times, it's automatic, whereas so many people never get to that. So that's a great thing to have.
This could be the old short-term, medium-term, long-term goal, isn't it? So rebuild your buffer if you've paid it, if you've pushed your emergency buffer down to pay it off, rebuild that, then put your long-term objectives there. Is it deposit on a house? Is it travel?
Yep. Cool. Like it. Good question. Great.
Right.
One debt-free medic.
Good things to think about. The next question is, what happens to my super if I die and don't have a will? So I'm just jumping across to Marley, who's a wills and estates lawyer at Nest Legal, to help us with this question.
Yeah, great question. So super is an asset that sits outside of your estate, so separate from property, cash, shares, cars, all of that, unless you bring it in. And what that means is that you've done a nomination on your superannuation account. So if you take the will out of it completely, you can do a binding nomination or a non-binding nomination on your super without having done a will. It's something that I tell all of my friends to do at the very, very minimum. Even if they don't have property, they don't have kids, if you've got super, definitely sort that out. So a few different types of nominations you can do. A binding nomination means that the trustee, so whoever is the top dog at the super company, whichever super company, if you do a binding nomination, they are bound by that decision. They have to follow whatever you've put on that form, as long as it's considered to be a valid nomination. And we'll go into a bit more about that in a second. You can do a non-binding nomination, which means that it's persuasive and the trustee of the super fund may follow it, but they still have some discretion. Okay. The other option is to do no nomination at all. If that's the circumstance and you haven't done a nomination, what the trustee of your super fund will do is a bit of a fact-finding exercise. They will firstly look to see if you've got a partner who's dependent on you, whether that's de facto or a spouse. They'll look to see if you've got children. It will depend on the ages of the children as well, with any tax consequences. They'll look for parents, siblings, the whole sort of down the family tree until they find the best person to pay your super to. Now, with super, there are beneficiaries who are considered beneficiaries for tax purposes, like a spouse or a minor child, but then there's also beneficiaries who will have to pay tax on it. I'm not going to get into the tax. That's not my area of expertise. With that in mind, if you want your super to go to someone who isn't a dependent for tax purposes, like a spouse or a child, then what you should do is leave your super to your estate. And then it forms part of the asset pool with everything else that you own and goes as per your will if you've got one, and if you don't have one, through the laws of intestacy, which again goes through your family tree to find who your most senior next of kin is. We see lots of people who say wouldn't want their parents to receive their assets. Maybe they would prefer it to go to a sibling. So in that instance, you should definitely have a will, because your parents, if you don't have a spouse or children, are your senior next of kin.
Who's considered a dependent for a binding death nomination form for your super fund?
Yeah, so it depends. You've got dependents for tax purposes. So that would be a spouse, including a de facto partner, children, as long as they're under 18, or under 25 living at home and studying. Okay, otherwise they're considered adult children and they'll have to pay tax. And you've also got interdependent relationships as well. And people who are interdependent may live together and provide financial support to one another, but they sit outside of that dependent term. So it might be a sibling or a parent or something like that. It's usually pretty difficult to get around that one. So my recommendation is have a will and specify who you want your super to go to.
What happens if you nominate someone because maybe you don't know all of this stuff that doesn't fall under that dependent banner in the binding death nomination form?
Yeah, that's a great question. So what will happen in that instance is the super fund, the trustee of the super fund, will find that nomination to be invalid. And then they will go through the same fact-finding exercise, try to find the best person to pay it to. And if there isn't a dependent, then it will go to your estate. There was a case a few years ago where a young girl had nominated her mum, which was, not a valid nomination. And so everything went to her partner who she was living with. So those weren't her wishes. She wanted her super to go to her mum, but there was nothing that could be done in that case.
To summarise everything we've just talked about, if someone doesn't want to get into that situation where they die and they don't have a will and it gets a little bit confusing about their superannuation, what should they do? Okay,
so jump onto the website for your super fund, download their latest binding death benefit nomination form, and either leave it to a dependent if you've got one or your estate, and then it will flow through as per your will. And I say that if you've got superannuation, you should have a will, right? It's an asset, and if you don't have dependents, it's coming into your estate anyway. So it's better to make sure it goes to where you want it to go.
Wonderful. Thanks, Marley.
Thanks.
Drew, do you have a binding death nomination for your super fund?
Yes, I do. So the important thing to remember with superannuation is that it is not an estate asset. So it doesn't automatically get paid to your will or your estate, which Marley explained so perfectly. So it is important that you have a binding nomination, whether that goes to a partner, child, or directly to your estate. In my case, directly to my estate.
Not your partner?
No, she's a she's a beneficiary of the estate as well.
Okay,
yeah.
so
More tax effective.
Right. Okay.
Yep.
Yeah.
Cool.
Yeah.
Have you updated yours as
If
well?
I'm not mistaken, they expire, right? Binding death benefit.
Well, there's
nominations.
lapsing and non-lapsing depending on what sort of super fund you have.
Yeah.
Yep.
You can fill them out by your superannuation fund and speak to your lawyer. So I haven't updated mine, but we have mirror wills, our partner and I, and I filled out the binding nomination quite a few years ago because I don't like the idea of a super fund being able to direct and tie things up. So also just consider your insurance.
Yeah. But it's a good reminder to check if you have set up this.
Yeah.
Talk to your super fund, talk to your advisor, talk to your lawyer, and make sure you just have a look at it.
Yeah, good one.
All right. Well, we've covered a lot in today's episode.
Yes, we have. We've covered everything from super and wills, HECS, Vanguard, and what to teach your kids, and even getting some feedback, some corrections to previous Q&As, which is great. We love to hear from you. So send us those in. A lot of good questions here that apply to everyone, whether you're new or experienced. But we do really appreciate your questions. As Kate said, even if we don't get to them in the Q&As, we do receive them. Drew and I answer them every week on the Investors Podcast. But we receive a lot these days, and we really appreciate that.
Yeah, and if we see common themes, we try and find a guest or an episode to fill that gap as well. We probably should remind people about the Rask Roadshow coming up, Owen.
Yes, well, you did mention Taylor Swift tickets earlier on. So
these are a bit more
Tay
achievable.
and Rask launched tickets on the same day. Wasn't to know.
You shut down Ticketek.
Yeah, Ticketek. Ticketek refused to work with us because we were so big, so they went with Taylor instead. But that's okay.
I see how that happened.
But we are going around Australia, if I'm not mistaken, to Rogan, Wangaratta, Sydney, Brisbane, Gold Coast, Newey. Yep, Port Macquarie, got good dolphin fish there. I'll be up there. Don't you worry about that, Kate. We're going to Townsville, furthest north we've ever been with an event. That'll be so much fun in the main stretch there. It was going to be at Flinders Lane for those of you in Townsville, not the Flinders Lane where we're recording right now. I know there are two. It's a great little precinct there, but we've moved the venue. In Adelaide and Perth, you guys are up first. So if you are listening to this and you are in the community over, maybe you're in Margaret River and you think, oh, I'll go up to the Big Smoke, no worries. Or maybe you're thinking, you're in the Barossa, you're sucking down some wines, get into the city and come and say
You're really
g'day.
selling this, Owen.
Yeah, it's $40. And by the way, that does include an hour of drinks and some bites. So heaps of
You're
giveaways.
definitely enticing people to come and see you.
Yeah. Oh, might be a Shiraz there too. So if you are coming down from the hills, you can have one of those too. But we're all going to be there. It's going to be heaps of fun.
There will
Looking forward
definitely
to
be
it.
people
Giveaways.
that aren't Owen speaking as well. So you get to learn from our property experts, our business podcast experts,
Drew.
some financial advisors.
You'll get a
Retirement advice.
interest rate prediction from Andrew Derrimouth. Dr. Andrew Derrimouth is
both.
coming along.
Am I rotating? Yeah.
Yeah, we do have a theme song, Kate. It has been chosen. It is not Cardi B. Don't worry about that.
Have you paid the rights to use this music?
Oh, have we ever? Of course. And that's about it. It's going to be heaps of fun.
Yeah.
It's going to be like this at night, which is going to be good.
Yeah, and I'll stop these guys from getting too out of hand. All right. Well, thank you very much for listening to today's Q&A episode. Hope you got something from it. Remember to send your questions in via the link in the podcast player. And Drew and Owen, thanks for joining me today.
Thank you.
Thanks. Good to see you.